Here's a look at Well, as investors get ready for Donald Trump's inauguration on Monday, our next guest is bullish on equities, saying they will be underpinned by good earnings and resilient growth. She sees more upside for the S&P 500, the broadest measure of the U.S. stock market, ahead in 2025. Brenda O'Connor Juanas is Senior Vice President and Financial Advisor at UBS, and she joins us now. Brenda, thanks a lot for joining us. The markets have taken a positive view of the most recent U.S. election since Election Day. We saw stocks move up really subsequent to the election. Why do you believe there's more to come here? The market obviously is pricing in a Trump administration.
Great. Thanks for having me, Paul. And look, the markets do have a pretty high bar to clear this year, and that's really because it had such a strong year. The S&P was up 23% last year. Now, look, we've gotten off to a little bit of a rocky start. It hasn't been all up, and I think that part of this bumpiness is counterintuitively because the data has been so strong. And look at that payrolls number that we just had. You know, as you mentioned, there's also going to be some uncertainty policy and politics-wise with Trump coming in on Monday officially, but we do think that overall, as you mentioned, that stocks, and I would say here particularly U.S. stocks, are going to be well supported, strong growth, solid earnings. Our target, by the way, for the S&P this year is 6,600. And Paul, I would say that, you know, we have one of the most conservative views on Wall Street, so investors could see it even higher from there.
What kind of earnings growth will be necessary to get to that 6,600 target on the S&P 500? We're looking at it right now. It's at 59.37.
Right. So our expectation is that the market is going to be up 9% EPS wise on the broad market. That's making us a little more comfortable with these valuations. Of course, the S&P is not cheap. You know, it's trading between 20 and 21 times forward PEs. And, you know, Paul, the biggest conversation I'm having right now is with clients that have been sitting on the side just watching markets roar by them. And of course, this is not necessarily a screaming buy, but I do think that that earnings justifies the markets at these levels. And I think even more so, if you are able to go into sectors selectively, that's where you're going to see outperformance. So we particularly like financials, and we still like tech for a third year in a row.
Why do you like tech for a third year in a row? The NASDAQ composite looks like it's set to take off this morning.
Right. So, of course, this AI narrative that we're all hearing, that we're all talking about, has really powered the NASDAQ for the last few years. You know, the other way to slice and dice this and look at tech outperformance is just look at the broad market last year, right? You have more than 50% of S&P performance from those 7 Mag 7 stocks. And I don't think that this narrative is over. We think that EPS growth for the tech sector alone is going to be 25%. Compare this with the broad market at 9, and that's where I'd be putting and allocating my money. And within tech, obviously, not all stocks are created equal. In terms of subsectors, we like semiconductors, we like some of these big cloud platforms. And yes, I still think that we have a ways to go here. And
you say you like the financials as well. Certainly, U.S. bank reporting season was a big success in the results we just saw. The fourth quarter results from major Wall Street banks were almost across the board very strong, but they depended a lot on trading gains for their profits. Do you think those kind of results are repeatable through 2025?
I do, and I think there might be different drivers or factors producing the performance in financials. You know, I think that rates coming down could be positive for banks. Our expectation is not that we're going to have 100 basis points or more of cuts from the Fed this year. We're targeting more 50 basis points starting in June. I also do expect that we'll see an opening up in the IPO market a little bit, which will also be positive for financials.
Gold was one of your calls in 2024. That obviously was a successful call, and you're sticking with that call. You think gold can make further meaningful gains in 2025?
Right, Paul. I was on the show a lot last year and I talked about gold a lot. And you know what? It did deliver. It was up almost 30% last year. I do think that gold still has a place in portfolios this year, and that's for a few reasons. Firstly, I do think central bank purchases and continued commitment to those purchases will provide support of the pricing. I also think geopolitically, you still need a hedge in portfolios. You know, we've heard news this morning that there looks like there's going to be an agreement between Israel and Hamas, but the backdrop overall still is fraught. I think gold serves as an important hedge. I would say that also, believe it or not, I'm talking to more and more clients about Bitcoin being a similar hedge in portfolios. I think that looks interesting as well. I'm definitely talking to clients a lot more about Bitcoin, but on gold particularly, I think outperformance is not going to be, double digits. I think you're looking at, mid-single digit returns this year. But again, the hedging purpose of having gold in the portfolio is going to be important for investors.
What about elsewhere in the commodity world? Are you constructive on commodities broadly in 2025?
Yeah, we do think the broad commodity basket is going to be up around 10% this year. So, broadly, I do like commodities. I like some of these industrial metals, energy. I think we have a price target of mid 80s. So it's not going to, we don't think that it's going to be up into 100 or anything. But I think broad commodities with selective selection of individual metals will be a good place to be this year.
Okay. And lastly, and we're almost out of time, what sectors of the U.S. stock market would you avoid in 2025?
I would say anything in the consumer area is not necessarily something that we would look at. We're putting a lot of emphasis on financials as well as tech, as I mentioned on the call. So I think that's where I'd be allocating equity-wise in 2025.